All right, now who do you have to be to apply? You have to be 18. Anywhere from 1 to 4 people can go on the application. Citizens can apply. Green card holders are good to go. H-1B visa holders are also good. Other visa types are going to depend. Based on visa types, we may or may not be able to offer traditional financing. But for the most part, you're going to need a social security number. If you don't have one, you'll need to get an ITIN number. And if you're in that camp, expect to have to bring a larger minimum down payment than usual. For minimum down payments, we'll start at the top. There are some special state and local programs, usually in your area, that will allow you to do up to 0% down, even for non-vets. But there's usually some sort of income requirements and more to do all that. And those can either cover some or all the closing costs. However, the rates may not be as good as for a loan with a traditional down payment. Next up, veterans can do 0 down loans through the VA. Then you move up into 3% down minimum down payments for conventional conforming. And in 2025, you can use a 3% down payment on a conventional loan on a sales price of up to about $830,000. And then if you live in a high loan limit area, you can use a 3.5% down payment on an FHA loan or a 5% down payment on a conventional loan on a sales price of right over $1.2 million, but that depends on what county you live in. Mortgage insurance, if you do not have 20% down, then you have to pay what's called mortgage insurance. It may be called PMI or MI. You do this in 1 of 3 different ways. One, it can be paid up front in a large sum to avoid having to pay a monthly amount. This is often expensive, usually costs several $1,000s. I typically don't recommend it for several reasons. Number 2 is a borrower paid option where you pay a little bit each month, and then that separate payment can typically come off a conventional loan once you reach 20% equity in the home. And then there's a third option, which is a lender paid option, which is an increase to the interest rate. Now, many people may think that they don't want to pay PMI, largely due to its reputation. Past generations, they had to pay PMI that was very expensive back in the day, but PMI can be much cheaper as compared to the past, especially if you got a strong credit score. With underwriting tightening up over the last 15 years, it's at the point where instead, if you wait up to save more, prices are likely going to go up in the meantime, and the housing price increase may then increase your overall payment more than just paying the PMI in the meantime. Now, saving up for 20% is an admirable goal, but may not be the most effective use of your money. There's a saying that you want to buy real estate and wait, not wait to buy real estate. The numbers out there, they show first-time buyers use an average of 6 to 7% down today. All buyers altogether, they use an average of about 12 to 13% down. I would say people even use 0, 3, and 5% down, like most often is what I see, to secure the asset and then let the home appreciation rise to grow their wealth. But all right, now not all sources of money are acceptable to use for a down payment. You can't use savings from your illegal fireworks stand you got running in your backyard. There's about 4 main ones allowed. Okay, number 1's your savings. It's got to be your money saved up. We have to check that by seeing your bank account statement over the past 60 days. If there's a deposit in there that's not sourced, it's cash, or is somehow unallowable, it's probably not usable. Number 2 is a gift. It almost always has to be from family. Can't be from your 2nd grade soccer coach. And it also has to be documented showing that it's coming from the donor's account, and they have to sign a letter saying that you won't pay them back for it. Third thing you can do is you can pull some money from retirement. It could require a short-term loan that you could have to pay back. And finally, you can find local or state grant program or a second loan even to cover the down payment. But those are the 4 main ways for a down payment. Moving on to income, the main income requirement is called your debt to income ratio. This is calculated by taking all your minimum monthly payments and dividing them by your gross monthly income. It usually needs to be within 15%. Sometimes the requirement based on product or program is higher or lower than 50%. But what is included in the monthly payment sum is your principal, interest, taxes, insurance, and if applicable, your mortgage insurance, HOA, or condo fees. Non-housing payments include credit card, student loans, auto, child support, alimony payments. Now, if the student does not yet have a payment required every month, then 1% of that balance is usually added to the minimum payment tally. It can be a little less on FHA and VA loans. But things that are not included in the ratio are things that the lender doesn't necessarily see as necessary, which are cable, utilities, car insurance, memberships, 401k contributions, health insurance payments. But that explains the debt to income ratio. Now for the main income types, very understandable. You got your base income, which is anything that's an hourly job or salary, it's guaranteed. Also pension or Social Security income count as base income. Base income is qualifiable right away. You don't necessarily need a full 2-year history of it on all programs to use it. And then there's variable income. Commission, overtime, and bonus money are considered variable income and most often need a 2-year history to qualify. Self-employed income also requires at least a 2-year receipt. Then the next is contract income. This is not indefinite employment, so we need to show that it will continue for at least 3 more years past the closing date. Government contract job would be an example of this. Alimony and child support also need to show a 3-year continuance in order to be counted, aka if the child was 15 years and 1 day old on closing day, then the income would not count because it would not be continuing for at least another 3 years past closing. For a new job, if you haven't received a first pay stub, you have to provide a signed and executed and accepted offer letter from your new employer telling us that you've passed all pre-work requirements. These requirements could be getting a security clearance, passing a drug test, background check, anything they require. All right, and so what if you don't have enough income to qualify for what you want to buy, but you do have a parent or somebody out there that is willing to go on the loan with you to improve your income? Well, that's what's called a cosigner. Someone who can go on the loan and have their income count for you on the loan. In this case, they're still legally obligated, and if there's a late payment on the loan, it's going to hurt their credit score. So don't pay late, don't upset them. And then if there's any debts, they are going to have to be included and counted against you in the debt to income ratio as well. So this is something that's usually done because you don't have enough income. Maybe you're getting a raise soon, or maybe the cosigner is just willing to help you pay. But this can help you get past the debt to income ratio barrier if you're up against one. Credit. What determines your credit score? The largest factor contributing 35% to your score is payment history. They don't want to see late payments. Number 2 is the amount owed on your accounts. It takes up about 30% of your score. This is really only related to credit card debt so much, but they don't want to see your balances over 30% of the credit card limits. Now, if you go over 30%, 50%, or further, you can reduce your score each time you pass one of those percentage tiers. Number 3, they want to see that you have had credit established for a decent amount of time. That makes up about 15% of your score. And number 4, they don't want to see that you've been recently setting up a lot of new accounts. That would suggest that you're a greater risk to lend to. That makes up about 10% of your score. And then finally, number 5, they look at a mix at the credit types that you have. They don't want to see that you have all these credit card accounts. Now, one thing that I need you to understand is that you don't necessarily need a whole lot of credit history to qualify for a mortgage. If you have previous history of paying off and making payments on credit cards or student loans, then fantastic. But a lot of times you don't need that much, all right? I've seen people be approved on the Fannie Mae, Freddie Mac underwriting system from having history of only one credit card where they were making consistent payments on. All right, so don't sweat it. You're not going to know until after you apply on whether or not you have enough credit history.